Hello and welcome to EduFund. In today's video, we have a very special guest with us, Mr. Sachin from UTI Mutual Fund. Sachin holds 22 years of experience in the portfolio management industry. He is a BCom graduate from Narsimunji College of Commerce. He is a postgraduate from KJ Somaiya Institute of Management and Studies, and he is a CFA charter holder from 2004 from CFA Institute, US. Sachin is a fund manager with UTI Mutual Fund and is managing UTI Transportation and Logistics Fund. Today, we will hear from Sachin about his journey and the process and the philosophy which goes behind managing UTI Transportation and Logistics Fund, which has completed roughly 15 years in the industry. Over to Sachin.
Thank you for this invite. So, as far as UTI Transportation and Logistics Fund, which is now in existence for more than 15 years and has an AUM of 2,400 crore, approximately that number. As far as this fund is concerned, here in this fund, we primarily invest in auto OEMs. Now, these auto OEMs is like sort of your Maruti, Tata Motors, Mahindra & Mahindra, Bajaj Auto, all of these OEMs who sells the vehicle to the end buyer. We invest in auto ancillaries. So these companies, these OEMs design the car, but there are multiple parts which goes into these. And these auto ancillaries are the ones which is the tires, the batteries, the screw, and multiple other things is what they provide. So they are part of the ecosystem. So that's where we invest in this fund. And the last piece which is the logistics piece. So everything that you buy and sell, somebody has to actually deliver from one place to other place. So we invest in logistics companies as well. So combination of these three large buckets is where we invest in this fund.
So, as rightly pointed out by you that this fund is a thematic fund, and of course, transportation and logistics is a sector which is going through, which is dependent, which is cyclical and is also dependent on the economic ups and downs. How do you mitigate the risk, and what has been your journey over the last 15 years? Or what have you experienced in this management of the fund over the last 15 years? How have you managed the risk and volatility during ups and downs?
So the best way for us to manage the risk is to stay invested in companies which are customer focused. To stay invested in companies which are customer focused, investing in creating new products and services for the consumer. But at the same time, it is very important for companies to remain profitable, generate cash flows, and most importantly, generate healthy ROCEs. Because unless companies don't meet these criteria, they face either a risk of extinction or they may face a risk of high volatility as far as share prices are concerned, which inherently create big volatility as far as fund NAVs are concerned. And that's why we tend to invest large proportion of our investments into the companies which are more of a high cash flow, high ROC, customer focused and growth oriented companies. That's how we try to mitigate these risks across the cycle. And of course, in cycles, you have to also pay attention to what valuations you pay to the companies. Very expensive companies at peak of the cycle may create volatility as far as underlying NAVs are concerned. So we try to avoid those mistakes.
Right. If you can also throw a little bit light on the investment process, on how do you construct the overall portfolio? While valuations and the cyclicality of the industry is one part, would your style would be more growth oriented or value oriented, or will it be a blend of both?
So it is a sector fund. So we have to be mindful that we don't have many options as far as sector funds are concerned. But inherently, the orientation is towards maybe I'll say growth, but not averse to companies if there are facing some cyclical headwinds and they are just turning around, like probably the entire sector is through that. But the inherent thought process about this fund is a growth orientation, because remember, as far as auto as a sector is concerned, although I know all the streets across the cities that we go, they are congested. We are all, if you are part of Bombay, Pune, or whichever city you come from, you must be facing those challenges of the traffic. But despite that, the reality as far as India is concerned, our penetration level is just under 2.5%. Versus this is compared to maybe 11-12% in China, and maybe 34-35% probably somewhere in that vicinity for the US. So we are highly underpenetrated country, so there is a scope for growth as far as this sector is concerned. The good part about this sector as of now, because it's also growth and maybe the industry, the way it is consolidated, we get to pick up a lot of companies with a good ROCE profile. So yeah, I think that's about the orientation. But like I said, we are not averse to holding companies which are going through cyclical risk. But yes, a complete avoid for us is the area of governance, which is where companies have once or twice demonstrated misallocation, or they have not been careful in treating the minority shareholder. Is clearly an avoid area for us.
Certainly. And this sector is also going to be very integrated with the global market. So do you see that as an opportunity, and are you playing some themes around that? And is that a risk? If yes, how do you mitigate that?
When we talk about auto OEMs, so maybe India, in as far as two-wheeler is concerned, is a big exporter. So your Bajaj Auto of the world, or the TVS of the world, or even to that extent Maruti's, the companies are exporting, and especially in two-wheelers we hold a good market share. Which is where companies have got good market shares in countries like South Africa, Egypt, or Sri Lanka, all the neighboring countries, and maybe in African continent as well. They, in some of these areas, our companies are market leaders. In tractor also, we hold good potential. And in light of, if our companies do good job, our companies, as far as OEMs are concerned, our companies may do a great job as far as four-wheelers as well is possibly concerned. But when we talk about auto ancillaries, which are suppliers to auto OEMs, they already are doing a good job as far as this space is concerned, because some of these companies, let's say the forging part of it or the wiring part of it, because India has this natural advantage of trained labor force. Cheap trained labor force. So some of these companies have over a period of time not just specialized in what they do, but now they are part of this global value chain, and which is where they are already benefiting, and I think more of these benefits are yet to come to these companies. So it's a great opportunity as far as Indian companies are concerned. One area which you touched about the risk part, obviously, like globally, I think the volumes have suppressed, especially post-COVID, which is where there has been a decline, and some of these companies have also faced those volume pressures. So we should be aware when we are investing that some of these companies will also get affected because of the volume decline if there is in the global markets.
You spoke about opportunity, and I think technology is playing a major role in shaping all the industries. And in fact, technology is also playing a vital role in the entire logistics space and the transportation space. How do you play this theme while selecting the stocks?
So yeah, I think one big change which is happening within the industry is this entire consumers are now got this opportunity to experience a complete new powertrain, right? Which is the EV is what we speak about. So it's not just the two-wheelers, which is where I think the penetrations have already reached 5% plus. But even in case of PVs, penetration is now somewhere in the vicinity of 2%. So now these new vehicles are actually not, they're basically performing the basic utility of taking you from one point to the other point. But more importantly, they are giving a new experience to the consumers as well, because these products are coming with new features. These products are basically, they give you a long riding experience, which is more convenient because there's no vibration inside the vehicle. All those experiences are there. Some of the listed companies, which are large listed companies in the OEM space, they themselves are occupying very large market share as far as EV is concerned at this point in time, and which is where we have exposure. Now, as far as auto ancillaries are concerned, yes, it's not true that some of these companies are completely only EV ecosystem. So some of the existing players themselves are catering to this emerging opportunity, and they are working with not just the domestic OEMs, but they are also working with the global OEMs. So some of the listed players are also part of the global value chain. So yes, this space is emerging. We would have exposure to many of these companies, but not that any one single company is having a 100% exposure from the emerging space. Now, as far as logistics is concerned, again in that space, a lot of new things have been attempted, and especially maybe the Amazons of the world or the Flipkarts of the world are able to deliver us goods within one day because of the good job been done by some of these new age companies, which are maybe the end cost of delivery has substantially come down, and which is where the good amount of trade is happening. Or maybe food delivery companies are possibly doing it at a cheaper cost. So yes, we are aware of these opportunities, we are investing in these opportunities, but the bigger space actually which is happening through emergence of technology is the 3PL, where the companies are giving more comfort to the manufacturers that they are better off playing their core part of either the manufacturing or marketing, and outsource these opportunities to some of these players, and which is where we have good exposure to the fund, and we are capitalizing from this change in technology which is happening.
No, I think certainly, because a lot of the entire e-commerce boom has actually led to the growth in the entire logistics space. And a lot of our investors actually want to play the theme of transportation and logistics. So if you can throw some light for these investors, how they should allocate the funds to these kind of a sector if they want to take a thematic bet, and what kind of horizon should they look at?
So typically the best time for investors to play these thematic or sector funds is when probably the market is mispricing, or when the sectors are facing tough challenges. Now, key challenge for investors is to figure out what's the right time, or what's the how do they figure out it. It's typically the time to invest in these sectors is when in the media or the newspaper you hear that the volumes in the sectors are down, companies are facing profit challenges across the sector, not just one company specific issue. If you see that if it is already established and past readings suggest that let's say auto is a cyclical sector, auto is a cyclical sector, and you figure out that yes, the companies are facing back-to-back volume challenges, and therefore the profits are also actually suppressed for these companies, because typically when volumes are not there, you are forced to give the discounts, and which creates additional profit challenge for these companies. These are the times, if you go and follow a traditional metrics of valuation, which is price to earning or EV/EBITDA, you may find that valuations are expensive because your profit itself is suppressed, right? And maybe that's the time for investors to actually probably go and invest in good quality companies, because at that point in time, if they think through that what is the normalized profit, maybe even at the peak, what was the normalized profit, if you do the calculation based on that, maybe you will see a significant upside as far as the sector is concerned. So maybe I will say investors need to think through about pick up, read what's there in the print, but then apply some of their own logic. If they can do it well, maybe they can actually benefit as far as cycles are concerned. And vice versa is also true. When to get out is the time when you see that the one specific sector is significantly doing well, and that's the time when the investors are happy to give them high multiples. So a typical mistake is high profits, high multiple, and that's the time probably I will suggest that investors should actually look to get out rather than getting in.
Yeah. A follow-up question on that. I mean, we have heard from a lot of investors saying that markets are roughly at around 66,000 currently, and it's very overpriced. It's very, having a very healthy valuation. So as an investor, we should wait for some time before taking an exposure through the lump sum route. What, in your opinion, would be the best way to take an exposure in a thematic fund? Would it be a lump sum, or would it be an SIP? And again, what if you can throw some light on the horizon part?
Okay, sure. So as far as UTI transportation and logistics is concerned, this sector has just recovering from the difficulties it has faced from 19, 20, 21, and maybe partly in 22 as well. These were volume challenges, these were multiple challenges, but in nutshell, from investors' perspective, it was due to multiple factors. The cost has gone up, which has made product prices unaffordable for the end consumer. this was the time when the incomes were, we all know post-COVID, the income challenges which India has faced, right? But now I think most of these challenges are behind us, the cost pressures are behind us. But at the time when the nominal income for average Indian is now going, and back to back 2 years, we have seen that there is a good recovery in the nominal per capita income. So which is where I think that there will be a recovery as far as volume and profitability of the companies are concerned. And maybe I think the big picture first as far as sector is concerned is that we are on recovery path, not just in volume but in the profitability as well. If you apply the same filter that we just spoke about, is basically that irrespective of the market levels, if you see that the companies on the normalized profitability level, if they are looking reasonable from a longer term perspective, which is what I feel they are looking at reasonable, then it's time to make a lump sum investment. At best, maybe you can break your investment in maybe 3 or 4 tranches, but it is the time for investors to invest and benefit from this recovery phase. In markets, you probably also have spent a good amount of time. There are phases when market go up or down, but if there is underlying profit recovery, market do respect that. And I think maybe this is a space which has seen difficulties. It's on recovery path, and which is where probably this theme is well placed.
That's all from our side. Sachin, thanks a lot for giving us your time and valuable insights. I'm sure our viewers would have drawn some meaningful insights out of this and would take decisions accordingly when planning their investments. Thanks a lot for sharing your
Thank you everyone.